All right, today we're going to pull back the curtain on something fascinating: algorithmic trading. We'll break down how these complex strategies actually get built and, put to work in the real world.
This really gets to the heart of it, doesn't it? Can a robot actually trade better than a human? It's this constant battle, human gut feeling versus cold, hard machine logic. So, what's the real story here?
Well, when you boil it all down, algo trading is really about three huge advantages: speed, precision, and efficiency. I mean, a machine can crunch information and act on it way, way faster than any of us ever could. And it does it with a kind of relentless consistency.
Okay, so let's get into it. If you really want to understand how these algorithms think, you've got to open up their playbook. We're going to walk through four of the most fundamental strategies that really power automated trading.
So first up, we've got trend following. And this one is probably the most intuitive of the bunch. The algorithm is basically programmed to figure out which way the market's headed, up or down, and then, well, it just jumps on for the ride. And yeah, this is the perfect way to think about it. The algorithm isn't trying to predict when the next big wave is coming. Nope. It's just trying to spot it once it's already forming and then ride it out for as long as possible. All right, next up, we've got the total opposite approach. It's called mean reversion. This strategy is built on the idea that, what goes up must eventually come down and the other way around. It's always looking for assets that have stretched too far from their average price, and it bets they're going to snap back. This analogy just nails it. The algorithm is designed to spot the exact moment that rubber band is stretched to its absolute limit, and then it places a bet that it's just about to snap back.
Okay, now for something completely different. This strategy, it couldn't care less if the price goes up or down. Seriously, all it cares about is that the price moves a lot. By buying these things called options on both sides of the price, the algorithm is basically just betting on pure chaos. Exactly. You're not trying to guess which way the wind is blowing. You're just betting that a hurricane is on its way. This is the kind of strategy you'd use right before some big news or an earnings report, when you're expecting a huge market reaction, but you have no idea which way it's going to go.
And last but not least, we have the breakout strategy. This one is all about momentum. The algorithm keeps an eye on these key price ceilings or resistance levels, points where a stock has struggled to go higher. The second it finally breaks through that ceiling, the algorithm jumps in, betting that this newfound momentum will carry it even higher. And it works exactly the same way for price floors or support levels. It's such a powerful image, right? The algorithm is just sitting there waiting for that green light, that breakout, to just floor it and catch that explosive move right from the start. So there you have it, the playbook. But here's the thing. None of these strategies work in a vacuum. They are completely 100% dependent on being fed the right information. Good data is everything. And that brings us to maybe the most important question of all. How do you turn all that market noise into a crystal clear signal that can actually drive one of these strategies?
Well, to answer that, we're going to do what the pros do. They analyze all this complex data, often from things like derivatives reports. These reports are packed with clues about market sentiment, where the big money is flowing and what it expects to happen. So we're going to dive into a real one from Axis Securities to see exactly how they find their edge.
Right, so the crucial part here is knowing where to look. It's like being a detective. In this absolute flood of data, there are clues that tell a story about where the market might be heading next. Okay, so our first clue comes from this open interest chart. Now, open interest is just a fancy way of saying the total number of active options contracts that haven't been settled. To put it simply, this chart is basically a map showing us exactly where the most money is being bet on future price moves. And right away, looking at this data, we can spot a critical number. We see the highest concentration of call options, those are bets the price will go up, is right at 61,500. So that acts as a ceiling, or what traders call a resistance level. The report also points out a floor or support level down at 60,000 based on the put options. So this tells us the market is probably going to bounce between these two levels. But wait, there's another clue here. The report points out that traders are paying more for put options, which are basically insurance against a price drop. Now think about it. When the cost of insurance goes up, it means people are worried. It suggests a bearish sentiment. In other words, the big players are more concerned about a fall than they are optimistic about a rise. Okay, so we have the clues, we have the sentiment. Now let's see how all this raw data gets turned into an actual concrete trading decision. This is where it all comes together. So here's the logic, step by step. Step 1, the analysis shows that bearish or negative bias and a really strong ceiling. Step 2, based on that, the strategy they chose is something called a bear-put spread. It's designed to make money if the price stays flat or even moves down a bit. And finally, step 3, the trade itself is structured to create a super clear risk and reward scenario right from the get-go. And here are the nuts and bolts, straight from the report. The recommendation is to buy a put option right at that 61,000 level and, at the same time, sell another one down at the 60,000 support level. What this does is create this really clever, risk-managed position that's built directly on the data we just walked through. And this right here brilliantly illustrates the beauty of a strategy like this. Look at these numbers. Before the trade is even placed, you know your absolute maximum profit and your absolute maximum loss. The potential gain here is more than 3 times the potential loss. That's a great setup.
So, after all that, what's the big takeaway? We've looked at the algorithm's playbook, and we've walked through the human analysis. The future isn't about one versus the other. No, the real edge today comes from this incredible synergy. You have a human analyst who can decipher the subtle clues in a report, just like we saw, design a really smart strategy, and then hand it off to an algorithm to execute it with flawless speed and precision. And all this leaves us with a really fascinating question for the future, doesn't it? As AI gets smarter and smarter, as the machines get even better at spotting these patterns, what do you think the primary role of the human trader will actually be? Will it be about high-level strategy, managing risk, or maybe something else entirely? That's definitely something to think about.